Fam, it's the $1 Million Ape, your go-to for smart crypto moves, real yield, and a warlord-level strategy in the on-chain jungle. Unless you've been living under a rug-pulled rock, you've probably heard about Bitcoin ETFs making waves in the news, headlines, socials, finance bros, even your uncle's retirement portfolio guys talking about it. But what is a Bitcoin ETF? Why does it matter? And how does it affect you, whether you're new to crypto or already stacking Satoshis? Let's break it all down, jungle style. First off, ETF stands for Exchange Traded Fund. It's a financial product that tracks the price of an asset, like stocks, gold, or in this case, Bitcoin, and trades on traditional markets like the NASDAQ or NYSE. So instead of buying BTC directly from a crypto exchange, you can now get exposure through an ETF, like buying a stock in your brokerage account. This is massive, because for the first time ever, Wall Street and the entire legacy finance world can invest in Bitcoin without touching a single wallet, seed phrase, or blockchain address. We're talking hedge funds, pension funds, family offices, retirement portfolios, all flooding in. In early 2024, the SEC approved the first wave of spot Bitcoin ETFs from giants like BlackRock, Fidelity, ARK, and more. Within the first few months, billions of dollars in net inflows poured into these ETFs, with some days seeing over $500 million in a single 24-hour window. That's not just hype, that's real institutional demand. And here's why it matters to you. Number one, liquidity and legitimacy. ETFs add massive liquidity to the Bitcoin market. They reduce volatility, tighten spreads, and make BTC more appealing to conservative investors who were previously on the sidelines. It also signals global acceptance. Bitcoin is no longer fringe tech. It's being embraced by the same financial institutions that once called it rat poison. Number two, price action. With institutions now buying Bitcoin in size, the supply shock is real. ETFs are required to back shares with actual BTC. That means every dollar flowing in is buying physical Bitcoin off the market, tightening supply and applying upward pressure on price. We're already seeing this play out. Since the ETF approvals, Bitcoin ripped past $100,000 and is now grinding into new territory. And we're still early. Some analysts, including Bloomberg's ETF strategists, are projecting hundreds of billions in potential inflows over the next few years if adoption mirrors that of gold ETFs in the early 2000s. Number three, retirement access. Bitcoin is now showing up in 401ks, IRAs, and traditional investment platforms. That means the average investor, without touching an exchange or cold wallet, can now allocate to crypto in their retirement portfolio. This opens up an entirely new demographic, people who want the upside of crypto without the complexity. But let me pause here and drop some clarity. Owning Bitcoin through an ETF is not the same as owning Bitcoin directly. You don't control the keys. You can't move it on-chain. You can't self-custody or use it in DeFi. And if the ETF's custodian gets compromised, guess what? Your BTC is locked behind red tape. That's why the real jungle kings do both. Here's how I play it. I hold real Bitcoin on my ledger. Offline, untouchable, mine. I use Nexo to earn yield on my active BTC stack, up to 7 to 8%, compounding daily. And I keep an eye on ETH trends to track where the macro money is flowing. This gives me full exposure, price upside, yield, and ultimate control. Let's take a step back. How did we get here? Just a few years ago, the SEC rejected every single Bitcoin ETF application over and over again. The excuse, market manipulation, lack of oversight, unregulated spot exchanges. Then came the lawsuits, the lobbying, the legal wins, and then the game changed. In 2023, Grayscale won a lawsuit forcing the SEC to reconsider its Bitcoin ETF denial. That was the domino. By January 24, over a dozen spot ETFs were approved. And in 2025, we're seeing Solana ETFs with staking rewards, Ethereum ETFs, and a bunch of others in the pipeline. This isn't just about Bitcoin anymore. It's about crypto becoming an asset class with regulatory clarity, institutional infrastructure, and serious long-term flows. And fam, this trend is just heating up. BlackRock's Larry Fink went from calling Bitcoin a money laundering asset to calling it digital gold and pushing for tokenized securities. That's not a pivot. That's a paradigm shift. So what does this mean for you? If you're a long-term investor, ETFs legitimize crypto. If you're a yield hunter, platforms like Nexo let you earn real passive income on your BTC and ETH with no lockups. And if you're about sovereignty, cold wallets like Ledger give you full control over your assets forever. But the smart move? Diversify your exposure. Use ETFs for clean access. Use Nexo for yield. Use Ledger for self-custody. That's the Warlord setup. Let's recap this jungle playbook. Bitcoin ETFs are Wall Street's bridge into crypto. They're driving price, adoption, and legitimacy. But they don't replace self-custody or yield strategies. Combine ETFs, Nexo, and Ledger to move like a king with control, growth, and income. If this video helped you understand the ETF wave, hit like, subscribe for more Warlord-level crypto content, and check the description for legit links to Nexo and Ledger. Stay based. Stack smart. Ape out.